Hey, so I was digging through some earnings reports today, and the Swiggy Limited report caught my eye. It seems like they just went public.
Oh, Swiggy? That's interesting. So, what's the headline? Are they swimming or sinking?
Well, they released their unaudited financial results for the quarter and 9 months ended December 31st, 2024. The report includes both standalone and consolidated figures.
Okay, let's dive in. First off, a little refresher for our listeners. Swiggy, the food delivery giant, but it's also more than that now. Can you give a quick overview of their business model based on the report?
Sure. So, Swiggy, formerly known as Bundle Technologies Private Limited, is primarily known for its on demand food delivery service. It connects consumers with restaurants through its mobile app and website, and they also have restaurant dining solutions via Dine Out and curated outdoor events via Steppen Out. They also have quick commerce with Instamart and supply chain services to wholesalers, retailers, and FMCG brands. Plus, they have platform innovations, which acts as incubators for new service offerings.
Right? It's not just about getting your biryani delivered anymore. They're trying to be an all encompassing convenience platform, it seems. So, any big strategic moves lately that we should be aware of?
Yes, the biggest one is that they completed their IPO during the quarter ended December 31st, 2024, raising a total of 43,589.82 million rupees after deducting issue expenses. Their equity shares are now listed on the NSE and BSE.
Boom, that's a game changer. Fresh capital and public scrutiny all at once. How did that IPO affect their share capital?
Well, during the same quarter, they converted a bunch of preference shares into equity shares. We're talking about Series A through K and bonus shares too. This resulted in a massive increase in their paid up share capital. I mean, this is a major shift in their capital structure.
Got it. Now, let's get to the numbers that matter. How's their income statement looking? What are the key figures for revenue, net income, and EPS?
Okay, so for the quarter ended December 31st, 2024, their consolidated revenue from operations was 39,930.69 million rupees, up from 30,486.92 million rupees in the same quarter last year. But here's the thing, they still have a loss. The loss for the period was 7,990.80 million rupees.
Ouch, revenue's up, but they're still in the red. What about earnings per share?
The basic and diluted EPS both stand at a loss of 3.48 rupees per share for the quarter.
So, growing revenue isn't translating to profitability just yet. What's driving the losses? Any one time items messing things up?
There are a few exceptional items. They include impairment on property, plant, and equipment, and expenses or reversals related to the IPO. These items definitely had an impact, but they don't fully explain the continued losses.
Right. So, it's not just one off costs, they've got some fundamental profitability challenges to address. What about their expenses? Where are they spending the most money?
A huge chunk of their expenses is in purchases of stock in trade, which was 15,573.77 million rupees for the quarter. Delivery and related charges are also significant at 11,269.41 million rupees. Advertising and sales promotion is next with 7,514.85 million rupees.
Delivery costs are always a killer in this business, aren't they? And it looks like they're spending a lot to attract and retain customers. Let's switch gears to the balance sheet. How are their assets, liabilities, and equity looking? Any red flags?
After the IPO, their paid up share capital significantly increased. I don't see any huge red flags immediately, but further analysis would be needed to assess their solvency and liquidity in detail. We advise investors to check with certified experts before taking any investment decisions.
Fair enough. I think it's a good time for a little pause. To all our listeners, if you're finding this insightful, don't forget to hit that like button, share this with your friends, and subscribe to our YouTube channel for more financial analysis. Okay, back to Swiggy. How's their cash flow situation? Are they burning through cash, or are they generating enough to sustain themselves?
That's a great question. Unfortunately, the provided document doesn't include a cash flow statement, so we can't really analyze their cash generation and usage right now.
That's a bummer. Cash is king, especially for a company still chasing profitability. Okay, let's talk about their different segments. I remember you mentioned they're in more than just food delivery. How are those segments performing?
Right, so breaking it down, food delivery brought in the most revenue at 16,368.81 million rupees for the quarter. Supply chain and distribution is also significant with 16,925.68 million rupees. Quick commerce through Instamart is growing with 5,765.01 million rupees. But in terms of segment results, food delivery is actually profitable with 1,927.15 million rupees. The other segments are still showing losses.
So food delivery is holding the whole operation afloat, huh? Instamart and the supply chain staff are still in investment mode, burning cash to grow. What about those platform innovations you mentioned earlier?
Yeah, platform innovations, which includes things like private brands and Swiggy Genie, is still a small part of the overall picture with revenue of just 228.59 million rupees and a loss of 105.25 million rupees for the quarter.
Okay, so it's like they're throwing a bunch of stuff at the wall to see what sticks. Now, let's zoom out a bit. What are some of the key trends you're seeing in this financial data?
Well, revenue is definitely growing, but so are expenses. They're still figuring out how to scale efficiently and achieve profitability across all their segments. The IPO is a big deal, giving them a cash infusion to fuel growth, but it also brings added pressure to perform.
Makes sense. So, what's your overall outlook for Swiggy? Are you bullish, bearish, or somewhere in between?
I'd say cautiously optimistic. They're in a massive market with huge potential, but they're also facing intense competition and the constant need to innovate. They need to show that they can turn revenue growth into actual profits.
Yeah, the food delivery and quick commerce space is a battlefield. They've got Zomato and Blinkit breathing down their necks. What are some of the key risks that could derail their plans?
Well, increased competition, changing consumer preferences, and regulatory changes could all pose challenges. Also, rising fuel costs and driver shortages could impact their delivery operations.
Good points. Any final thoughts or recommendations for investors based on this report?
Swiggy has shown strong revenue growth and a successful IPO. However, the path to profitability is still uncertain. Investors should monitor their expense management and segment performance closely. Overall, it's a high growth, high risk investment at this stage. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
All right, thanks for breaking down that Swiggy earnings report for us. Always good to get a peek behind the curtain of these big tech companies.